Well, good morning, everyone. Go and get started if you don't mind. I'm Anthony Cordone, the Executive Vice President here at Visit Lauderdale. We're welcoming all of you to the STAR presentation today. It's really exciting to do this every year, of course, and hopefully hear some good news moving forward for our forecasting. So before we launch into that, I just want to give everybody a heads up to make sure that you check out visitlauderdale.com/partners. There you can go and find out some of the opportunities to participate with Visit Lauderdale at different trade shows and events throughout the next year. That gives you an opportunity to also include some of these in your budget potentially. So I've got that up on the website right now here up on the screen. If you go down, you click on partner opportunities and then follow through the link, it'll bring up a list of a lot of the different events and trade shows that we're going to over the next year and how you can get involved in all of these. So take a few minutes to check that out. Again, it's visitlauderdale.com/partners. It'll be up here updated regularly, and we're looking forward to seeing you involved with us for the rest of the year. So without further ado, I'm going to go ahead and introduce you to Ted Bottomer, who is brand new with us. He is our Vice President of Research and Revenue here at Visit Lauderdale. So Ted, do you want to go ahead and get started?
Absolutely. Thanks so much, Tony. Appreciate it. Well, it's great to be here at Lauderdale. I've been on board for about 2 months now and have spent a lot of time. I'm from the airline industry previously and worked in other rent-a-car and other such things. That is, so it's again, great to be here, but we're very lucky today to have Daryl Cronk here, the Director of Hospitality Analytics for CoStar, which is the parent company of STR Global. Daryl comes to CoStar with more than 20 years of experience in the travel and tourism industry. He worked for a long time running market research at Visit Orlando. So again, without further ado, Daryl, take her away. And it's great to have you. Really appreciate you taking the time.
Thank you, Ted, and good morning to everyone. Happy to be here and do this update. I'm going to run through our thoughts on some of the trends that are taking place in Fort Lauderdale, and I'll share our industry forecast for the market, as well as some of the other markets in Florida, provide a little context for it. As Ted said, I'm with CoStar. CoStar is the parent company of STR. Back in 2019, CoStar acquired STR. And so if you're not familiar with the CoStar brand, that's who we are. We are now STR. So let me go ahead and share my presentation and we will get started. Okay, hopefully you see the presentation and it is up. If you don't, please speak up and let me know, but I will go ahead and get started. And first we'll start off with some good news, and that is Florida continues to be among the best performing markets. So what you're seeing here are the 40 largest hotel markets in the country. That's 40 largest based on room count. And they're ranked based on their performance for the first half of this year compared to the first half of 2019. So we're still using 2019 as that baseline or that benchmark pre-pandemic. And you see Florida is doing extremely well. So Tampa is leading the top 40 markets, the strongest growth over their pre-pandemic baseline. But then you scroll down the top and you see some of the beach destinations like Virginia Beach, then you see Fort Lauderdale, a little further down Miami, a little further down Orlando. So all the main Florida markets are outperforming the total US and in general doing extremely well. And the reason we're doing so well is basically rate growth. This has been a rate-driven recovery. We typically think of occupancy coming back, giving hotels pricing power to raise rates. Well, this has been rate-driven from the beginning because occupancy has not returned to pre-pandemic levels in any of the top 40 markets. But ADR is, with the exception of bottom right, you see the two California markets there, San Francisco and San Jose. So it is, a reminder, a little bit of a humbling reminder that there are still markets out there that are not back to 2019 levels. So while we here in Florida think about how well we've performed, there are still places that are lagging behind where they were at this point 4 years ago in 2019. But things are changing. To borrow the song from Bob Dylan, the times they are changing. Because if we replace this comparison to the pre-pandemic baseline and just look at year-over-year growth, suddenly the ranking changes dramatically. So now the Florida markets are over in the bottom right. All the Florida markets except Orlando are underperforming the overall industry. So you see the total US on the right, that is up about 9% year over year RevPAR. Trailing that, there's Tampa, Virginia Beach, Fort Lauderdale, Myrtle Beach, New Orleans, Miami. You're starting to see these markets that performed so well the last couple years are now slowing. The markets that are performing really well now in terms of year-over-year growth are the urban markets. The places that were lagging behind are now having their moment in the sun, so to speak. So DC, New York have an extremely good year. Vegas is doing well. Boston, Raleigh, Durham doing extremely well. We think about some of the segments that were slower to recover. This was truly led by the leisure transient category, where now we're seeing business transient starting to come back. Group is coming back. Education, government-related travel. So a place like Raleigh, state capital, Research Triangle, all the universities. These segments that were lagging behind are now having their moment, and we see that reflected in the markets that are performing the best. And we can take RevPAR and split it out between OCC and ADR. And again, this is first half of this year compared to first half of last year. And the biggest difference we see for the Florida markets is that rate growth is slowing. So in fact, if you go down to Miami, rate has now started to trail prior year levels. Tampa is doing okay with rate growth. Fort Lauderdale is getting a little bit, about 2% rate growth. But the big difference is compared to 21 and 22, the rate growth is not there to drive RevPAR anymore. So here's Fort Lauderdale's 12-month RevPAR. And I just want to, again, a little bit of this about adding perspective. And so go back to 2008, great financial crisis. It was 57 months, almost 5 years for rolling 12-month RevPAR to get back to the 2008 peak. This time, it only took 2 years, 24 months. February of 2020, by February of 2022, Fort Lauderdale's 12-month RevPAR was already fully recovered. The slope of that line, that V-shaped recovery, is remarkable, and has continued to go up since then. Now you do see on the far right, 12-month RevPAR has begun to come down this year, and so it peaked in February of this year. It's come down about 2% so far from February through June of this year. So a slight decline. It's not plummeting. I've gotten a few calls from some folks in South Florida talking about falling off a cliff. I try to talk them back from the cliff a little bit. Yes, things are slowing, but we are not seeing the type of dramatic fall off that we saw in the Great Financial Crisis, for example. So what's going on is that the momentum has faded. We had a really strong start. Part of that strong start was a little misleading. So we have to think about January, February of last year, which was benefiting or not benefiting, impacted by the Omicron variant, kind of the last surge of the pandemic, December of 21, January, February of 22. So this year we had relatively easy year-over-year comps to start the year. So you see RevPAR almost 30% up year-over-year in January. Well, by the time we get to March, we've moved past those easy year-over-year comps. And in fact, March, April of last year is when the group segment really began to take hold and began to recover. So as we move into the spring, we had much more challenging year-over-year comps. We expected year-over-year growth was gonna slow. That strong start to the year was a little bit of a misleading indicator because of the comps with the Omicron variant. I will say, though, by the time we got to May, we were a little surprised that it not just slowed, but actually went negative. And so RevPAR was down actually March, April, and May. A little bit of improvement in June. Things are trending back up. Hopefully that's going to continue into July and August. But this is not a market-specific issue. We're seeing this across the state. So here are the other major markets across Florida. Fort Lauderdale's the dark purple line. That's, again, year-over-year growth each month in RevPAR. Florida as a whole, the state, is the dashed purple line. And then we see some of the other markets like Palm Beach, Miami, and the Keys. You see the Keys have been down every month this year, and that's really rate driven. We'll see that in just a moment, but the Keys rates are coming way down. Miami is suffering from lower ADR as well. In general, Palm Beach is doing well. They bounced back in June with very modest growth in RevPAR. So here's the year-to-date numbers for comparison. So Fort Lauderdale is seeing about 3% growth in RevPAR year over year. All of the Florida markets are trailing the industry as a whole. So the U.S. is up about 9%. So again, this is a reflection of Florida had its moment in 21 and 22, and now some of these other markets are driving growth. We look at Miami and the Keys, though, they're actually gone negative. So they're down year over year in RevPAR. And the reason they're down is rate. So if we take RevPAR and split it out between OCC and ADR, we see that occupancy is basically flat. For the state, it's at 0, Palm Beach +1, Miami -1. Basically, occupancy is flat. So RevPAR is being based on ADR growth, and Miami and the Keys are not seeing ADR growth. Their ADRs got so high, they're finding that they just can't maintain them now. And we'll talk about why in a moment, some of the shifts that are taking place that has taken away some of that pricing power. But right now we're seeing ADR growth slow dramatically across the state and actually go negative in South Florida for Miami and the Keys. So that's a high level overview. What I want to do now, we're going to dig a little deeper into what's happening, offer a few suggestions as to why this is happening, what we think is going on, and then I'll conclude with our forecast and what we see for the end of this year and in 2024. So first, another little feel-good slide. So if we look at the submarkets in Fort Lauderdale, and this compares RevPAR for 2019, 2022, 2023, year-to-date June of each year. And what you see is that every submarket in Fort Lauderdale is experiencing growth. RevPAR is higher this year than it was same time last year, and it's well above where it was pre-pandemic. And remember, there's some markets out there, Minneapolis, San Francisco, to name two, that are still below 2019 levels. So a little perspective of how well Fort Lauderdale and Florida in general has performed, and is continuing to perform despite the slowdown that we're experiencing. If we look at the year-over-year change, the Hollywood Airport submarket is seeing the strongest growth. A couple things that are perhaps driving that. One is the airport is doing very well. Total passenger volume is up about 14% year to date at the airport. Cruising is doing well. We're going to talk about cruising more in just a moment, but to the extent that someone might fly into the airport the day before a cruise, spend one night probably at a hotel near the airport or maybe near Port Everglades, getting a little bit of extra pickup from that increase in cruise traffic. And that's really, we see that because that's the only market with really any occupancy growth. Airport occupancy up about 2%, although it has the slowest ADR growth, about 1.5. Otherwise, we're seeing basically flat occupancy and around 2% ADR growth across the market. And the growth this year has shifted from transient. Really 21, 22, it was really all about the transient leisure traveler, weekend guest that was driving growth. Now we're seeing it's the group segment that's driving growth. Now, group is only about 18, 19% of total occupancy. So group on its own is not enough to really drive the overall market performance, but it provides a little lift. And if group wasn't up so much, we would actually be seeing declines because, as you see, the transient numbers are down modestly year over year. And what we're seeing with transient, I have a coworker that used the phrase reset. Another phrase we're hearing a lot is normalization. So if we look at transient occupancy, again, this is year to date through June for each year. Pre-pandemic, 2019 was about 58% in the first half of the year. We see that fell in 2020 when everything got shut down, locked down for the pandemic. Look how high transient occupancy soared in 2021, 65%, well above normal transient occupancy for the market in the first half of the year. So what we've seen in 22 and in 23 is a slow, gradual return to more, we'll call it normal, transient occupancy levels. Meanwhile, on the group side, group bottomed out about 5% in the first half of 2021 and has slowly been inching up the last couple of years. So we're seeing, again, a little bit of a reset. Transient, after that big surge in 21, is slowly reverting or normalizing to pre-pandemic levels, while group slowly rises to pre-pandemic levels. So again, use the word reset, use normalization, but we're not anticipating a dramatic slowdown or fall in the numbers. Really, it's more of just kind of that reset. And it really stands out if we break it out by month. This one's a little bit busy. I apologize, a little bit of an eye chart, but the dark gray hash marks, that's 2019 occupancy. The lighter green, the first bar in for each month, is 2021. And what you really want to notice is in April through July of 21, look how high transient occupancy was above 2019. Completely disrupted typical seasonal pattern of occupancy falling through the spring. May occupancy of 21 hit 70%. So there were some abnormal patterns that took place because of the pandemic, and what we've seen last year really began and now really happening this year, returning more to the pre-pandemic seasonal pattern, pre-pandemic levels of transient occupancy. And that's really behind the slowdown that we're seeing not only in Fort Lauderdale, but across the state of Florida. And just to illustrate that, here we compare Fort Lauderdale and Florida, the year-over-year change in transient occupancy. And so again, it's not market specific. We're seeing this slowdown across the state. And in fact, Fort Lauderdale's transient occupancy got a little bump in both May and June, while the state as a whole continued to trail prior year levels. Now on the group side, this is actually, to me, a little more concerning than the transient. The transient we can explain based on normalization, returning to more normal seasonal patterns. Group, ever since group overlapped the uptick that started in March and April of last year, group has actually lagged prior year levels. This has been a little bit of a surprise. I've talked to a number of hotels, CVBs. I was in Tampa about 2 weeks ago. Everyone keeps telling me that the group calendar for the fall looks really good, that we're going to end the year well, that the group recovery is going to continue. So I'm taking them at their word. That's what they're saying. But I'm a little concerned at how quickly the group recovery began to lose momentum in March and April of this year. So again, reset or normalization. Transient is slowing. Group, at least until recently, was slowly improving. We think that's just a bit of a reset, but kind of why? What's behind it? And to understand the why, we have to understand how travel changed because of the pandemic. So 2020, everything shuts down. It begins to gradually reopen. Florida was among the leaders in reopening and reducing some of the pandemic restrictions. There was this sense that being outside was safer than being indoors. Drive travel became more popular than fly. And what we began to see was travel shifted towards beaches, national parks, more rural destinations, places where people could be outdoors and have some sense of control of their surroundings. Social distancing was, the buzz term for a while there. Well, all that has faded. Really, after the Omicron variant of early 2022, by last summer, most restrictions were gone. There was still a little bit of hesitancy, a little concern among some travelers. So really, this year is the most open, competitive travel landscape since 2019. Basically, travel at this point is unencumbered by any restrictions, concerns, or really much influence at all lingering from the pandemic. And so we're seeing travel begin to shift back to what it looked like pre-pandemic. And I'll show you 3 examples of what I'm talking about. First is international travel. So this is from the US government, and the graph compares travel by US residents going out of the US to an overseas destination. That's the blue line. And what we see is that by the end of last year, outbound overseas travel by US residents was above 2019 levels, was fully recovered, and it's remained above that this year. Europe in particular has been extremely popular. The Caribbean and Central America also above their pre-pandemic levels. Now, conversely, inbound travel, so that this would be an overseas resident coming into the country, is still down more than 20% from pre-pandemic levels. So this information explains a couple of things we're seeing. One is I've gotten a lot of questions in the last month or two about Well, how come hotel data is lagging, whereas passenger traffic in the airports is growing so dramatically? I mean, Fort Lauderdale Airport up about 14%, international passenger volume at Fort Lauderdale Airport up 35% year to date. Well, why isn't that translating to hotel demand? Well, because a lot of that is being driven by outbound travel, US residents that are now traveling overseas. Because if they're leaving the US on an international flight or they're coming back to the US on an international flight, that's international, even though they are US residents. So we have to be a little careful about comparing airport data to the hotel data. There are some nuances there. Cruises have come back with a vengeance this year. Port Everglades is reporting that multi-day cruise passenger volume up about 88% year to date. The Port of Miami has reported that their volume's up 100% the first half of this year and is now above the same period last year. So again, if you've got someone flying into Fort Lauderdale Airport the day before a cruise, they're spending the one night and then boarding the cruise ship the next morning, that's not generating a whole lot of demand. Maybe one night in that airport submarket, if they're staying near the airport. But in general, that's competing. That's competition for the domestic traveler that is instead getting on a cruise ship. And then we're seeing a dramatic shift in where the domestic traveler is going. So at the bottom of this list, unfortunately, we see places like Tampa, Fort Lauderdale, and Myrtle Beach. So these beach-oriented leisure destinations that really led the recovery in 21 and 22 are now seeing travel shift to some of these urban markets that have lagged behind. So Washington, D.C., New York, even San Francisco. San Francisco is still RevPAR down 30% to 2019 levels. So they're in a deep hole. It's going to take a long time to come out of it, but they are rebounding. They're seeing demand growth over 10% this year. So there's been a shift in where the domestic traveler is going that is influencing us here in the Florida market. And then the other thing going on, there's some economic factors. One is the spend down of excess savings. So there's been a lot of talk about pent up savings during the pandemic. People working from home, they couldn't travel, they weren't going to concerts and movie theaters and eating out. The stimulus money that was mailed to all of us, this excess savings. Well, the Federal Reserve Board put out a report in June that they concluded that this excess savings has essentially been depleted. So that excess savings was helping shield the consumer from inflation, from higher interest rates. One of the most remarkable things economists have been talking about is how resilient consumer spending has been despite these headwinds of inflation and higher interest rates. With this excess savings depleted, there's an expectation that those headwinds are going to really start to affect the consumer more strongly in the second half of this year, which is raising recession concerns. Could there be a recession if the consumer pullback were to get a little stronger? And then the last thing to keep in mind, little not as quite on the radar as the recession concerns or inflation, but this fall, student loan payments are being resumed. They have not been required since the pandemic started. So for 3 years, there have been no student loan payments required. That picks up in the fall. So there's literally millions of US households that are going to have to start making monthly payments of hundreds or even $1,000 a month that they haven't been making. That's going to eat into some of their discretionary income and how they spend their money. So there's several headwinds that we think are going to start to affect the consumer and could have some bleed over into their travel patterns in the second half of this year. So with that in mind, this increase in competition from international travel, from cruising, from other domestic destinations, and with the risk of some economic headwinds maybe getting a little stronger the second half of the year, what do we think is the future for the rest of this year and into next year? So here's our forecast for the Fort Lauderdale market. Right now, CoStar's baseline forecast does assume a brief, mild recession starting late this year, ending early 2024. I emphasize brief and mild. We do think it will have very little impact overall on travel. In fact, STR's official U.S. forecast is for RevPAR growth of around 4 to 5% this year. It is the first time STR has ever forecast RevPAR growth in a year with a recession. So the consensus is that the impact of the recession will be mild. Now, for Fort Lauderdale specifically, basically we're seeing 2 years of little to no growth. And this year and next year end up being mirror images. So if you think of a timeline with January of 23 on one end and December of 24 on the other end, January of 23 started off really strong, partly because of the easy year-over-year comps against the Omicron impact. Then we go into this slowdown, this soft period that we think extends through the end of the year and into the beginning of next year. And then performance begins to pick up by the middle of next year. And we finished 2024 relatively well. So kind of mirror imaging, strong start, softness, and then 24 softness, strong finish. The net result is basically little to no growth. So RevPAR growth, -1 this year to next year. I call it flat, basically flat growth for this year and next year. A little bit of occupancy, a little bit of ADR, but basically not much growth in any of the metrics for the next 2 years. And again, not a market specific issue. We're seeing this across Florida. So here's the forecast for some of the major hotel markets in Florida. The Keys we think will start to pick up later this year, but that's because they started to decline second half of last year. So they're already into their softness or their reset. Their ADRs got so high that it seemed inevitable they were going to have to come down, and they are coming down. But we think by next year, 2024, the Keys will start to see some growth opportunities returning. Fort Lauderdale, around 2% growth next year, all of it from ADR. Miami, not much, maybe 1% growth, less than 1% really, 1 if you round up. Palm Beach, again, about 1, Tampa, flat. So really across the state, we're seeing basically little to no growth this year and next year as this normalization or this reset in travel patterns really kind of plays itself out. The total US, we're forecasting about 5% RevPAR growth. And the total US, the total industry, that's coming from those markets that are seeing the recovery now that had been lagging behind. So again, Midwest or Northeast urban markets in particular, the New Yorks, the Bostons, the Chicagos, Minneapolis, that we think will start to recover. And so now I'll wrap up a couple minutes looking at the pipeline. So rooms under construction basically have plateaued over the past year. And we're seeing this across the industry. Rooms under construction flat or even down. As rooms open, new construction starts aren't keeping pace. And there's a number of factors going into that. One is interest rates. You go to get a construction loan because of the Fed's fight against inflation, raising interest rates. It's become much more expensive. So that has delayed some projects. And that's if you can get a loan. Lending standards have gotten much tighter. So there are some that have just opted to pause. There's a number of projects that are just sitting in what we call final planning, the last stage before construction. And the timing on those projects in final planning, we've seen start to get pushed and shift as the companies behind the project just kind of hold and wait on to see what happens with credit markets. So here's a timeline of the pipeline in Fort Lauderdale. So this year, there's only about 258 rooms under construction and expected to open. And there's even fewer in 2024, about 237 rooms under construction and expected to open. At the moment, there are no rooms under construction with a 2025 opening date. So there's potentially a bit of a pause in the pipeline in 2025, and then 2026, 800 rooms. You're probably well aware of that. That's the Omni Fort Lauderdale that's scheduled to open early 2026 is what we have currently on our calendar. The lighter shade there, that's the final planning counts. And that's what I was referring to, projects getting to final planning and then pausing. So right now there's about 650 rooms in final planning that have said they're going to start construction this year, open in 2024. I'm growing increasingly skeptical of that. If they're not under construction now, a 12 to 18-month construction window, they're starting to really push the concept of being open in 2024. And so I think we're going to see some of those rooms in 2024 in final planning will start to get pushed to 2025. Some of the 2025 rooms could get pushed to 2026. So in general, we anticipate a bit of a slowdown in the pipeline, certainly in 23 and 24, and then we'll see what happens in 2025. And if we compare Fort Lauderdale to the other, again, the top 40 hotel markets, we tend to rank them based on rooms under construction as a percentage of their existing inventory. So that's a way of just gauging the potential impact as the rooms open on the market. And so Fort Lauderdale right now has about 3.5% of the existing inventory under construction. That's slightly above the national average, which is around 2.7%. So on that metric, Fort Lauderdale is a little bit on the high side, but again, 800 of the roughly 1,300 rooms under construction is that one property that we've penciled into early 2026, the Omni. So it's not like all 1,300 rooms are going to open overnight. The impact of those rooms are going to be spread out over the next basically 3 years. So I'm not too worried about the impact of supply growth on occupancy or the other indicators. I think Fort Lauderdale is going to be able to absorb those rooms just fine. Certainly would be more concerned about a place like a Fort Worth or an Austin, where you're seeing 6-7% of the existing inventory under construction. That's a lot to absorb over the next couple of years. And so here's the listing of what we currently have as far as under construction and their projected opening dates. So 2 relatively small properties, one that we expected to open in July. We'll verify if that has in fact opened or if the date's changed. The Aloft in December. We got 2 properties next year, and then the Omni in 2026. So wait to see what happens in 2025 if some of these rooms in final planning do in fact start construction and start to target 25. So I'll wrap up a few key takeaways and then happy to take any questions. But again, I just want to emphasize, yes, things have slowed, but this is not 2009. We're not anticipating a severe recession or slowdown, really more of a reset or normalization. Travel is returning to more normal patterns as the pandemic has basically now faded from its influence. And so transient is softening. Transient is shifting. It's moving to other markets. It's moving overseas. It's getting on cruise ships. Group is recovering. We expect it to continue. We hope it continues into the fall, but it has slowed a bit here in the spring. A few headwinds, competition, and then some of the economics that we're watching through the second half of the year. And basically, we think that where we're at now basically continues into mid next year. So basically, little to no growth this year or next year in those key headline metrics. And in a sense, fortunate that with demand growth slowing or plateauing, at least we're not worried about significant supply side pressure on occupancy, so that the hotel pipeline is fairly modest over the next couple of years. So I know I covered a lot and probably spoke a bit fast. Happy to take any questions, dive deeper if you have any.
Now's your time. Jump in there. Any questions from the hotel partners?
Happy to take questions. And I also love your feedback. So you're there in market. Love to hear you. Is what I'm sharing on track, or do you see anything different? I welcome any and all feedback. It's helpful for me as well.
Ina?
Yes, good morning, everybody. A couple of questions. First of all, I know Pier 66 is going to be opening supposedly in 25. Where are they in your numbers?
I can look them up and get back to you. We do keep our pipeline. I can in the background here try to get it open real quick and see if I can spot it for you.
Well, that's just something for you to consider. But my bigger question right now, because we've heard a lot of feedback on this regarding groups, and that is cancellation of groups regarding because of the political climate we're in right
Yep.
now. And more of a concern, quite frankly, is the people that are not sending RFPs to this destination. Can you talk about that for a moment?
Absolutely. And it is definitely something I've been talking to destinations around the state. There is legitimate concern. Here in Orlando, we've had 5 or 6 at the convention center cancel. I was in Tampa 2 weeks ago presenting to their Hotel Motel Association, and the head of sales for the Tampa CVB said at that time, they have not had any cancellations, but they have had a lot of questions, a lot of meeting planners coming to them wanting to know what they're doing about it. The more concern is, you're right, the lead volume and cancellations we know of, they call and tell us. What's concerning is that if lead volume falls, we don't know why. They just stop sending us the leads. Talking to Mike Waterman here in Atlanta, or talking to the head of the VP of sales for Tampa, they're reporting strong lead volume. In Tampa, they were saying, in particular, the smaller, say 250 on peak or less, extremely strong lead volume is they're still seeing. So it's going to be hard to monitor. I know companies like Cvent, or if you get future pace reports, can try to keep track of that. But you're right, it is something that destinations around the state are concerned about. The lead volume falling off because of meeting planners simply taking Florida out of the consideration set.
Heiko, I see your hand raised.
Yes, thank you. Daryl, great presentation, by the way, very informative, and I think for most of us, not a surprise with the information that you provided. I think our industry has talked about this now for a while, that we are in a cooling off period and things are getting back to normal. There's one segment that you did not talk about with this bit, which is business transient. What is your gut on business transient? Is it on a recovery? Certainly not as what it was before. What we are seeing in the marketplace, I would say maybe 50% at what it was in the marketplace before. That's my gut feeling, being a downtown hotel. But what do you see, Daryl?
Yes, absolutely. Business transient is one of the biggest topics of discussion and debate. I've heard estimates of, okay, let me start by saying business transient is recovering. We are seeing, and one way we can look at that is we look at things like midweek occupancy versus weekends. We look at CBD, central business districts, as a location. That occupancy is starting to come back. Clearly, it trailed weekends, it trailed resort locations, CBDs trailed resorts, but it is coming back. There's a general consensus that some element of business transient is permanently lost, whether it's because of the work from home, hybrid work model, or just technology. Even if you're in the office, we're just like this event, we're using Teams or Zoom, and we don't have to travel the way we did 5 years ago. So I've heard estimates of anything from 10% to as much as 40 or 50% of business transient is permanently gone because of technology, the adoption of video technology. I think 50% is high. What we're seeing in markets like Chicago and Boston, some of these traditionally heavy business transient destinations, it's coming back. It's not back to pre-pandemic levels. So I would err more on the 10 to 15% side, but it is coming back very slowly and clearly has lagged the transient sector.
Thank you.
Just a quick clarification on Ina's Pier 66. STR actually classifies that as a renovation. So it may not have fallen into the pipeline when you pulled the pipeline. I just looked it up for you. So
Thank you.
just as a clarification, I guess they were listed as a renovation and not an actual new opening in the pipeline. So I think that's why there was a little bit of a difference there.
Got it. Thank you for looking that up for me. Appreciate it. And yes, just to clarify, Candace is correct. The STR pipeline is new construction versus renovations. So Pier 66. We're seeing a lot of this in Miami as well. There are a number of some of their older Art Decos that are going through renovations down there. Most of it going to high-end luxury hotels. Alberge is one example. That's Amman is another one being developed out of a renovation of existing properties.
Other questions from our hotel partners? Going once. Yes, Joshua.
Hi, thanks for your time today, Daryl. But quick question on the forecast for Fort Lauderdale at 2%. Is that, focused in any one of the submarkets? And do you have any information related to forecast on the submarkets?
Yes, we do. We have forecasts available at the submarket level. So I can pull that by submarket and share that with Candace to then be shared with the group if you'd be interested, because yes, it is available at the submarket level.
Thank you very much.
Yep.
More questions? Hang on, it looks like I have somebody's hand up there.
Rosita.
Oh, hi, Rosita.
Hey, great presentation, Daryl. Thank you so much for giving us such a great overview of the past, present, and the future. One of my questions was, I know that STR goes by numbers of hotels that report, but do you factor in vacation rentals and Airbnb and all of these other accommodations that compete in our markets when you're talking about your numbers?
They are not included in the KPIs, the key performance indicators. So OC, ADR, RevPAR is for hotels participating, and then we model the non-participants as well to try to include them. So we do not include vacation rentals. We have we meaning STR. STR has a loose partnership with an organization called AirDNA. So they share some of their data with us just on a general level. And my understanding is that the vacation rentals are down, at least industry-wide. I can't speak specifically for Fort Lauderdale, but they are down sharply. Vacation rentals had their moment in the sun, so to speak, after the pandemic, when people, again, that focus on social distancing, a little bit of an isolation, made them appealing. We are hearing that they are seeing a decline in demand and falling ADR. I can use Orlando because that's where I'm based. They're down significantly here, and it's showing up in Orange County TDT collections, because we would use the hotel data to model what the hotel tax should collect, and collections were coming in much weaker than expected. And when we dived into the vacation rental data, we think that was the source of it. So again, I don't have the data for Fort Lauderdale, but just in general, the trending we're hearing is that vacation rentals are softening more so than hotels.
Yeah, that's consistent with what we've seen in the data that we pulled from a different competing source. So yeah, that's we're very much in line with the other markets.
Other questions? Ina, did your hand go back up?
Yeah, just a request. Can we get a copy of this presentation?
Absolutely. We will be posting it to the partner website as well as the recording.
Okay. This was really valuable, so truly, really impactful, especially the timing, since we're going into our marketing plan, final planning, both with the Marketing Advisory Committee and our Tourist Development Council. So
good. Yeah, hopefully it was helpful. Happy to do it. My pleasure.
I see a question in the chat. Is there any projection for luxury hotels in Fort Lauderdale?
Yeah, I can pull that with the submarket and send you over a summary. Yep. Make a note for that here.
Great. Any other questions while we have it? All right, going once. Going twice. I need Mayor Fisher on here with his auctioneer voice. Hearing or seeing no other questions or hands going up, I think that is a wrap. Thank you so much, Daryl. Greatly appreciated. Very, very good information for planning purposes and going forward. We appreciate that. And we will be posting this on the partners site probably later today, first thing in the morning. So watch for it there. Thanks, Daryl. Appreciate it. Thank you, everyone.